Trick CMT. He's chief market strategist at the Carson Group and a CNBC contributor. Not making his debut on the Durkin Show. We've done this before. My man, really nice to see you. Always grateful for your time.
This was an honor. I don't know the guy before me. He wasn't all that good, but I'm going to try and do better.
I won't tell him what you said.
He just heard me.
Yeah, I think he's probably nearby.
That's my buddy Sonny.
I'm going to start with the important stuff. I feel like I saw you and your family. I don't know if it was a Cincinnati Reds game you did this week. You did something that looked awesome. And when I'm stuck here at work, I'm like, I like seeing my friends do fun stuff. What were you up to?
Bark in the Park. So it would have been 2 nights ago. So we took our 125-pound Great Dane named Mabel to the game. And she did great, but it's a little boring. The Reds had 2 hits. So it was like the world's most boring game. And I don't know what you call it, but the big, scary, like, truck that drives on the field with all the noises. It's got some name. Like, they call it Redzilla. Long story short, Redzilla drives right by all the dog section, revs up the engine, lights. All the dogs go nuts, including everybody. It was a fun evening. Nice summertime thing, but the Reds only had 2 hits, so that was frustrating.
So I assume they lost.
They did lose. It was actually a close game. But
you could be like the New York Mets, who can manage to hit 4 home runs and still somehow lose the game the way they did yesterday. The Mets come up with really inventive ways to lose.
Certain teams do that. Reds are right there with them. But I'm excited to be back for the second edition of the JD Show here.
Well, a great team is the team at Carson Group. So let's get into it. You brought us this chart. Producers chart 1, the stock charts 1. S&P right back, basically at record highs. Looks like we're in the green today. 0.4%. What is more impressive here? You think the index itself, or the fact that breadth continues to improve?
Yes. So that's at the bottom there. We're showing breadth improving. Number of stocks above the 20-day, the 50-day, the 200-day. And this is something I've been talking about for a while, because you can see on the chart there, it bottomed and it's trending higher. Yet the market's been weakish. And just the last couple of days, I mean, today is another perfect example. I know Mag 7's really faltering as we talk, but I looked, industrials, JD, are 3%, at least right before we started to do this. Things are broadening out, and that's a real fascinating situation. 2 days ago, when the S&P dropped 1.4%, right? Tech was down on 3 or 4%, big down day. There were more up stocks than down stocks on the S&P 500 2 days ago, even though the S&P was down more than 1%. That's only happened 5 times, going back like 20 years. So that's some pretty rare stuff. And now only a sample size of 5. I don't get too worked up on it. We just need to know that's really rare. But this rotation under the surface, I think, is healthy, and it's not really bearish. Yeah, if you're all in big cap tech, it's, well, doesn't feel too good. This is why I know Sonu talked about this before I was on, why we've been preaching be overweight equities, but stay diversified.
Okay, interesting. So you are right on the Mag 7. A lot of them getting clobbered. Tesla's up fractionally at this hour. Industrials up 2.8%. So our leaders today: industrials, healthcare, materials, financials. We go down to the bottom of the pack. We got discretionary, real estate. All right, that's fine. But tech, up 0.3. You like this type of rotation. You like to see, not necessarily, as Sonu and I were talking about, it doesn't just have to be the generals leading the pack all the time.
I don't think so. No, I think it's nice to see the soldiers participating. And one of the ways we invest a lot of money, right, at Carson Group. We manage a lot of money for our advisors and our clients. And we've been taking like some barbelled approaches to a lot of it. Momentum on one side, low vol on one side, large cap on one side, small cap on the other. I mean, I assume right now, the time we're doing the small caps are up 20% for the year. And they literally hit an all-time high just yesterday. Small cap advanced decline lines just hit a new all-time high. What's that mean? Again, participation, breadth. These trends are real, but don't go all in one area, because, I mean, tech has done amazing. I mean, 6 months ago, everybody loved Mag 7. We get it. They're master of the universe all over the magazines. I remember seeing some of the magazines coming out and said, ooh, that's a very high bar. And if you would have talked to someone and said, I don't know what Microsoft's down for the year, 20, 30%, close enough for government work, down a lot, I would have said, ooh, I bet we're having a rough year. But we're sure not. I mean, we're not, right? We're doing just fine. I mean, at the time we're doing this, S&P's up ballpark 8 to 9%. JD, fascinating thing about that, only 4 times in history has the stock market gained between 8 and 10%, about an average year. So what's it tell us? Bigger moves are much more likely. So are we really going to finish right here, right about an average year? I mean, I know Sonu laid it out before it came on, and we're saying no. We're still saying there's upside. We've got about a 15% target in the S&P 500. Our mid-year outlook comes out in a couple weeks. We're probably going to up that a little bit. So we're still pretty optimistic here.
Remind me of the price target. What was it?
15% on the S&P 500.
15% off these relative levels.
Yeah, well, that'd be for the year. So it's about between 78 and 7,900. But we're probably going to up that here in a couple weeks. But I hate to give targets as a strategist, even though it's kind of my job. When we manage real money, we're overweight equities. We're always kind of tinkering and then sell a little this, a little that. But we're still over a 60-40 portfolio, right? That's kind of the benchmark for a diversified portfolio. We're about 68, 69% equities, about 31% other stuff. Yes, there's some bonds in there, some managed futures, some gold, but really in that big bucket, we still like the U.S. A lot. We like Europe a lot too. Emerging markets, not as much, but emerging markets, we think you get plenty of tech exposure if you own the U.S. So believe me, the time we're doing this, there's a lot of new highs hitting around the globe. So that's something to be thankful for as investors.
So you mentioned the Mag 7 year to date. Not a whole lot going on. Microsoft down 26%. We got Alphabet in the lead.
Hey, I said between 20 and 30, didn't I?
You did. You nailed it.
Yeah,
You nailed that one. I asked this question to Dan Ives several years ago.
Oh, boy.
I'm going to throw this at you.
Okay.
If you had to add one stock to the Magnificent Seven to make it the Elite Eight, what would you add? Oh, you almost went AVGO.
Yeah.
Nice. Okay, good. I like that answer.
So I don't follow individual equities very closely.
I was thinking that.
I can talk about anything. You kind of scared me with that. But I think that one, that one's, or Wendy's. It's a joke. Wendy's the last couple of days. That thing's up.
Producers, Wendy's chart, please, from Wall Street Bets.
We can talk about that if you want. Wendy's is that's that meme trade. That's
let's do it.
Someone from Ohio. Wendy's is based in Columbus. So there is, when I see stuff like that, there's pockets of optimism, right? There's pockets of, look at this excitement. We saw the big IPO, obviously, recently, and more IPOs are coming. But I tell you, JD, when this market's still doing what it's doing, I just don't see a lot of optimism. I don't see a lot of excitement. I really don't, and there's some pockets of it. Bull markets are supposed to be fun. Right? You mentioned Dan Ives. Dan's the man. Dan got his name run through the mud last year a lot, and I didn't like it, but it is what it is. Sure. And Tom Lee's been bullish. People just kill these bulls when the market has a normal correction, and nobody's ever going to always be right. But when I see that, I'm like, just from that contrarian point of view, I don't think we're that close to a peak. I think one of the charts I sent you, hopefully I'm allowed to cut in here.
Yeah, we're doing
just the length of the bull markets. So if you can find that one, the length of this is now the
June swoon,
the eighth longest bull market. There it is, that one right there. Right?
Chart 4 producers. Can we skip ahead? We hear 8th longest bull market.
Sorry, when you invite me, we just
no. Let's do it. Do this how we rock and roll since World War II.
Since World War II, this bull market now just what's the word I'm looking for? Eclipsed the length of the bull market in 1960s. This is the 8th longest bull market. Okay, what does that mean? As you can see on the screen, the previous 7 usually had a lot left to them. Okay, 6 of them made it at least 5 years, average of 7 years, and a lot of potential gains. So we've been saying this for a while. Bull markets are like a cruise ship. Once they get moving, they're hard to slow down, they're hard to turn around, they're really hard to stop. Yes, the Fed, if it got super duper hawkish, and you might have talked about that with Sonu, like if the Fed did become super hawkish, we don't think they will, that could kill it. A 100-year pandemic can kill it. Yeah, there are things that can stop it. But outside of that, it just, once these bull markets get moving to a certain age, they tend to keep going. And it's not that simple. There's more to it. Sure. But it's something to be aware of when you're an investor looking at this market, saying, oh my goodness, we're so overbought. Maybe tech's overbought. But like we just talked about, financials are finally starting to take the baton. Financials have not done well this year. It is what it is. But community banks are starting to lead. Regional banks starting to lead. Maybe those large super banks, those large banks are going to start to take over. I know Bank of America is doing well. Not all financials doing well. But that lifeblood of a bull market, we mentioned our buddy JC Peretz, he says this all the time, lifeblood of a bull market's rotation. To see that rotation away from tech into some other areas, hey, I think it's perfectly fine from a diversified portfolio's point of view.
Let's jump back to chart 2 if we can, because I do want to ask you about June swoon. For people who are unfamiliar with what that phenomenon means, what does it refer to, and what are we seeing right now here in the final days of not just June, but somehow and possibly the first half already of 2026 out the window?
Yeah, another way to put it, this is the second quarter, last I checked. Yeah. Historically, if you look at a 4-year presidential cycle, all the different 16 quarters, this is the worst quarter on average. This is why we say this isn't gospel, though, because we're up, I don't know. Well, we're up 15% the first 2 months, down a little this one, but we're having a heck of a rally the second quarter. But June swoon, June's usually not that great of a month. And as we're showing on the screen there, it's the second half of June right there. The second half of June is usually when that weakness happens.
I like you are here, by the way.
I shared that, I think it was almost 2 days ago.
So I make sure you know where in the calendar.
And it was a joke because I said the good news, we're halfray through the June swoon. The bad news, we're only halfway through the June swoon.
That's
sometimes there's some social media fun to it. But we're not overly shocked that June's a little choppy. Again, in a, what are we, a midterm year? In a midterm year, June's by far the worst month. But again, we don't blindly invest in these seasonals, but we pay attention to them. And after literally like the greatest April-May rally we've ever seen, to have a little indigestion in the late June period, not overly surprised. I know another chart I sent you is how June never peaks. If we go to that one.
We're going that one. That's chart 5, I believe.
So June.
Stocks rarely peak.
And there it is. Yes.
For a year around now. What does this tell us for history? Investors should be thinking about year-end upside.
Yes. Again, out of all 12 months, the only month that's never had the ultimate peak was in June.
That's wild.
So to put some context around, it is. Put some context around this last all-time high for the S&P was June 2nd. We haven't hit one since. Now, maybe we're inching closer. We're not there, but we're inching closer. Could that really be the peak for the year, JD? Sure, could be. We'd say no. We would say no. And looking at that particular, was that a gong? What was that?
Yeah, it's a celebratory gong.
All types of noise. All types of noise around here. Anyway, there it is again. The ultimate peak is probably not June 2nd. And that's what that tells us. And we've laid out other reasons why. But it's just a neat little thing to think about that never peaked in June. And I don't think this is going to be the first year.
Now, correct me if I'm wrong. In this midterm election cycle, if my memory of the Stock Traders Almanac serves me correctly, we do
shout out Jeff Hirsch. Jeff Hirsch is awesome.
Jeff Hirsch. We do set up the sweet spot of the 4-year cycle, which comes after we have the results of the midterm election, which oftentimes means what I always call the broken Congress. So right now, Republicans control the White House, both chambers of Congress. More than likely, Democrats take back control of at least the House of Representatives. That means less likely you get new onerous regulations that get imposed on companies. Everything kind of hits stalemate territory. That can really be a sweet spot. But again, history tells us that comes after the low spot of the midterm cycle, which we're not experiencing right now. So history works until it doesn't, I
There's
guess.
a lot there. Let's unpack it a little bit. So in a midterm year, the peak to trough correction is 17.5%. So from the peak to the lows intra-year. That's the most out of a 4-year presidential cycle. Off those lows, and no one knows when the lows are. That's the caveat. I get it. But off those lows in a midterm year, JD, market's never been lower a year later, up like 32% on average. So that's something to think about. The other one, like you just said, you tend to get strength after the midterm elections. Now, why is it? I mean, there's talking about the June swoon. There is some weakness historically the second half of midterm years. You know that election's coming up. You know there's going to be a shift in power. Please don't shoot the messenger here. But we looked at the last 23 midterms, right? The party that, how do I want to word this? The party that lost the presidency gained seats in the House 20 times. So it's just normal. That's the motivated party. An average of 29 seats. What does that mean? Well, maybe the Democrats take back the House. Maybe the Republicans maintain the Senate. That's kind of where we are. That's called a split Congress. Maybe divided Congress is the best one because the last 13 years, we had a split Congress. S&P 500 is higher. Yeah, there's random stuff and there's other parts of that, but I don't think that's a total coincidence. You have a big red wave or blue wave, that's when you start spending too much money and you do stuff that doesn't benefit everybody, right? And 13 for 13, that's not a bad thing. And if we get a split Congress coming up in November, that might be a positive. Now, as my friend Sam Stovall says, if the opposite of pro is con, then the opposite of progress must be Congress. So let's always shout out to Sam.
Oh, wait, that's really good. That's a Sam Roism?
No, Sam Stovall.
Sam Stovall.
Sam Stovall. He's
wait,
the man.
That's epic. I love that one.
Sam's got tons of them. You should have Sam on or something.
I worked on Capitol Hill for 5 years. I never heard that one.
Really?
That's a really good one. You always hear the same isms kind of go around the hills, like, life here is much more like Veep than it is the West Wing. Like everyone says the same stuff.
Okay.
That one's really good. I like
Sam.
that one good.
Yeah.
But it's really fascinating. We don't really do politics on this particular show, although it's kind of my past life. But I think it is interesting. And I feel like the market over these last, let's say, 10, 15 years, it does tend to find the silver lining.
Yeah.
So even when it's a clean Democratic sweep, you might have a little bit of a knee-jerk reaction to the downside, but then investors start to think, well, maybe this means increased infrastructure spending. Maybe there's other things to now sort of turn our attention to, and these midterm elections will be interesting to see how the dust settles.
I don't like talking about politics either, but I mean, from an investment point of view, we have to. Just something to be aware of. Well, if it's obvious, it's obviously wrong is another quote, because I'll tell you, the last 3 or 4 presidents, if President Obama wins, this has to happen. If President Trump wins, this has to happen. You know, with President Trump, coal's going to do well. No, coal did poorly. Under President Biden, coal did really well. These things, if everybody's talking about it, just be leery. That's why we say stay diversified, look at the fundamentals. Don't get too worked up. I mean, President Trump is supposed to be the most pro-Bitcoin president ever, and he is. I just got an alert. Bitcoin's in its 365-day low right now. So, and it's, it's just one of those things to be aware of when it comes to investing.
Let's pull up 7 if we can here while I still have Ryan, because you've been generous with your time as well. We love magazine covers. We do this with, hold on, where's my chart here? We do this with JC Peretz all the time. Look at this one.
Yeah.
Red, white, and blue. Feeling very blue. George Washington. Why'd you send us this one? I love it.
That sums up sentiment, I think, in a nutshell, because the consumer confidence numbers, and there's different sentiment polls, yes. The Michigan one is lowest ever, but you look at the other one. But still, overall, people just don't feel good. And then you look at last week's retail sales. Consumers are still spending. You look at the last 3 months of the labor market. Over 500,000 jobs created. Just to put some context around that, we made 100,000 jobs all of last year. So the labor market's coming back. People are still spending. It's not perfect out there. We understand inflation and the war and all the terrible headlines. But again, that cover that we just shared there, George Washington, a little hungover, kind of had a rough night, not doing all that well. That's not what you see near major market peaks. It just isn't. I've been around the block. I've seen a couple cycles. Usually bull markets are supposed to be fun. Doesn't mean you can't have a 5 to 8% pullback at any time, but it just isn't what you tend to see. And I like to see those types of covers. And the economists, they're kind of skewed a certain way. Economists just been bashing everybody for the longest time. Every time they put something, I mean, they were saying, crude oil had only one way to go, and that was up. It's literally cut in half since then. So as long as these same magazines keep saying the same stuff, which is everything's terrible out there, from an investor's point of view, I think you want to be overweight equities.
What would make you more cautious from where we are today?
Well, there's two things I really follow. I'm not talking sentiment, just markets, right? Advanced decline lines. How many stocks went up versus down? Literally today, if we rally, and it's a pretty broad-based rally, knock on wood, the time we're doing this, we might hit new all-time highs on the New York Stock Exchange advanced decline line, the S&P 500 advanced decline line. We're already at small caps and mid caps. If we start to see deterioration in advanced decline lines, we've seen that before major market peaks. So we're not seeing it. I want to be very clear. Then the credit markets. I'm an old school guy. I like to keep it simple. If credit spreads on like triple B and the various spreads start to increase and expand, that tells you there's maybe stress in the system. Well, again, good news, we're not seeing that at all. So those are the two things we watch very closely, and it gives you some potential cracks, some warning signs. The other one, and it's a JC special too, is what staples are doing relative to the S&P 500. So on a relative basis, staples have underperformed very, very by a wide margin. We like that. You want staples to be the worst performing group on a relative basis because that's the market's way. I'll never forget 2021, the fourth quarter. Everybody had money from the government. Stock market's up a whole bunch. Everybody's day trading. Everybody's doing this and that. But the top group in the fourth quarter was staples, low vol. There was something under the surface that was happening that nobody, well, I shouldn't say nobody, very few people were paying attention to. And then we had what happened in 2022, down 25%, bear market, all that stuff. So we're not seeing that. We're not seeing low vol lead. We're not seeing staples lead. Those are things I'm watching closely for clues from the market, message of the market.
No disrespect to the Coca-Colas, the Procter & Gamble's, the Walmarts, the Costco's, the one that makes up the consumer staples world of things.
And there's a spot, I'm assuming someone who talked about that. We've invested that way. Low vol on one side, high momentum on the other. Yes, high momentum we like more, but if something were to happen there, at least you've got a little bit of everything in your hedge either way. So nothing wrong with those companies. Hopefully they keep going up, just not up as much as other areas if you're bullish, overall like we are.
Dude, I feel like such a lucky broadcaster because this is the first half of the show kind of became like a special Carson Group blowout edition of the JD Durkin Show. Yeah. I'm really grateful for you and Sono. Dude, before I let you go, where can people go, Ryan, if they want to see more of your stuff, man?
Appreciate that. So Facts versus Feelings is the weekly podcast that I do with Sonu every single week. Comes out on Wednesday. So Facts versus Feelings, obviously Twitter at Ryan Dietrich as well. And then our blog is Carson Group. That's CARSON, carsongroup.com/research. I do daily blogs. Sony does daily blogs. Our team's talking about all the cool stuff that you and I just spoke about. But honestly, Facts versus Feelings is our podcast. We do it all the time, and it's a blast, and I love people check that out.
Dude, you're the absolute man. My best to you. Safe travels, and if you do get back to the ballpark, I hope you get to bring your dog with you every time.
Four times a year they have this. We said we might bring her next time, but the game was so boring. But we might bring her next time. But I hope to see you later tonight. We're going to make you hang out. So hopefully that works out.
Take it care. Thank you both for coming in. All right, we're going to bring in our next guest. I'll tell you what. Pop over there, grab you, leave your mic, and I'll pull it in. I think we got our next guest joining us. So control room is going to make this up as we go. I'm going to pull over the stool.